Welcome to this week's market update, where we review the key developments that shape markets, highlight what drove our recent performance, and look ahead at important events on the horizon. Let's start with what moved markets this past week. The big story was an extraordinary rally that pushed US stocks to all-time highs, driven by powerful momentum in AI and innovation. The S&P 500 gained approximately 10.7% in just 11 trading days, making this one of the fastest rallies in market history. This remarkable strength reflects strong investor confidence in how artificial intelligence is driving real productivity gains and creating new growth opportunities. For our portfolios, this environment continues to reward our focus on high-quality companies positioned at the forefront of technological innovation, exactly where we've been concentrating our allocations. On the economic front, March industrial production moderated slightly by 0.5%, following February's strong, upwardly revised 0.7% gain. Importantly, underlying trends remain healthy, with manufacturing activity stabilizing and jobless claims declining. Forward-looking indicators like new orders and shipments keep improving, painting a picture of the economy growing steadily without overheating. This soft landing scenario is exactly the backdrop that supports both our equity and bond holdings, allowing companies to grow earnings while inflation stays in check. Meanwhile, markets held on to record levels impressively, with the S&P 500 pushing past 7,000 and the Nasdaq 100 reaching new highs, even as oil prices approached $100 a barrel. The ability to sustain these levels despite external pressures shows just how strong the underlying demand for quality equities remains. Technology leadership continues driving performance, while market breadth improves, meaning more companies across more sectors are participating in the recent rally. Now let's look at what drove our performance over the past week and why we remain confident in our current positioning. Microsoft was our top performer with an outstanding 12.65% gain, driven by powerful momentum in its AI and cloud computing business. Enterprises continue rapidly adopting Azure, while Microsoft integrates generative AI tools across its entire product ecosystem. This creates multiple streams of recurring revenue that investors love, and it's exactly why we hold Microsoft as a core position. The information technology sector led our performance, with standout contributions from Microsoft, NVIDIA, and Broadcom. AI-driven earnings growth continues translating into real revenue, supported by stable interest rate expectations, ongoing enterprise AI deployment, and sustained investment spending by major cloud providers. We remain confident in our significant tech allocation because these companies aren't just riding a trend. They're building infrastructure that powers the next generation of business innovation. Our size strategy delivered strong results this week, with mega cap leaders like Microsoft, Tesla, NVIDIA, Amazon, and Alphabet all posting impressive gains. This reflects an ongoing flight to quality, where investors concentrate capital in companies with the scale, liquidity, and earnings visibility needed to navigate any environment. These giants have the resources to invest heavily in AI and innovation while maintaining their competitive advantages, which is why they continue rewarding patient investors. Looking ahead, here are the key events that we're monitoring that could shape markets in the coming week. Monday brings Canada's latest inflation report. Recent data showed headline inflation falling to 1.8% in February from 2.3% the prior month. This is the softest reading since July. Core inflation tracked by the Bank of Canada eased to a 4-year low of 2.3%. This is encouraging news for Canadian investors, as easing inflation gives the Bank of Canada more flexibility on interest rates and supports both equity and bond performance. Tuesday's U.S. retail sales report will be closely watched after February's data showed a robust 0.6% monthly increase. This is the strongest performance in 7 months. Strength was broad-based across department stores, health, and personal care, clothing, and even motor vehicles. Consumer spending is the engine of the U.S. economy, and continued strength here supports corporate earnings and reinforces the constructive backdrop for our equity holdings. Thursday's jobless claims report remains our most timely gauge of employment health, with the most recent reading falling to 207,000, which is below forecasts and signaling that layoffs remain limited. Strong employment underpins consumer spending and corporate profits, so continued low claims would reinforce the soft landing narrative and support our positioning in high-quality growth companies. Thank you for joining us, and we'll see you next week.